Could the familiar silhouettes of Toyotas, Hondas, and Subarus really disappear from American highways? For decades, these vehicles have been as much a part of the American landscape as baseball and apple pie, trusted by millions for their reliability, efficiency, and value. But now, a question that once seemed impossible is being asked in earnest. Are we on the verge of seeing Japanese cars vanish from our roads? This once unthinkable question now echoes in both Washington and Tokyo, reverberating through the halls of power and boardrooms alike. Political leaders and industry experts are scrambling to assess the fallout as the world's two largest economies find themselves at a crossroads. The imposition of severe new tariffs by the United States has upended decades of trans-Pacific automotive trade, forcing Japanese automakers to confront a future where their largest export market is suddenly fraught with peril. Shipments that once flowed smoothly now face delays and uncertainty, and the cost of doing business has skyrocketed almost overnight. Japanese vehicles are woven into American culture and economy, but the new tariffs threaten to unravel this relationship, compelling a fundamental reassessment of business models and investments. Dealerships that once thrived on steady shipments of Japanese cars now face empty lots and anxious customers, while automakers must weigh whether to shift production, raise prices, or even pull back from the US market entirely. The speculation about a Japanese exit, while extreme, is rooted in a real crisis that's forcing every major automaker to reconsider its US strategy. Boardrooms are filled with urgent discussions as executives debate how to navigate this new landscape and protect their brands' futures. The era of easy access and predictable profits is over, replaced by a new reality of adaptation and survival. As the dust settles, the fate of Japanese cars in America hangs in the balance, and the choices made today will shape the roads of tomorrow. The crisis began with the US imposing sweeping new tariffs on imported automobiles and parts, effective April 2025. Japan faces a 24% tariff, enough to threaten the entire business model of its automakers. For a $25,000 car, that's an extra $6,000 before it even reaches the dealership. Manufacturers must now choose between absorbing the cost, raising prices, or losing market share, none of which are sustainable. The announcement sent shockwaves through financial markets, with Japanese automaker stocks tumbling and global volatility spiking. For decades, Japanese companies optimized their US operations for efficiency. Now, the 24% tariff turns that system into a liability. Every aspect of their business, from sourcing to pricing, must be rethought. The tariff wall is a declaration. The old rules no longer apply. The US is the cornerstone of Japan's auto industry, accounting for nearly 30% of its global automobile exports, about $40 billion annually. While Toyota and Honda have US factories, brands like Mazda and Subaru rely heavily on imports, making them especially vulnerable. A sudden 24% cost increase threatens their competitiveness and long-term viability. The Japan Automobile Manufacturers Association and government officials have sounded the alarm, warning of severe fallout for both economies. Japanese automakers can't simply walk away from a market that's too big to fail. The US is where reputations are built and R&D is funded. This crisis leaves Japanese companies with no choice but to confront the challenge head-on, seeking every possible strategy to preserve their presence. The pressure to adapt is immense and unavoidable. Mazda, more exposed than its peers, found itself at the epicenter of a brewing storm in the US auto market. Unlike some competitors who had diversified their manufacturing bases, Mazda remained heavily reliant on Japanese production for its American sales. In fact, a staggering 80% of Mazda vehicles sold in the US are imported directly from Japan, making the company especially vulnerable to sudden changes in trade policy and tariffs. When the tariffs hit, Mazda made a bold decision. Instead of passing the extra costs on to customers right away, the company chose to absorb the full financial impact for all vehicles already en route or in the sales pipeline. This meant that at least for a while, American buyers wouldn't see sticker shock at their local Mazda dealership. Prices remained steady, even as costs quietly soared behind the scenes. But this strategy came at a steep price. In just 1 month, Mazda's decision to shield its customers and dealers from the tariff's impact cost the company an estimated $100 million, a staggering sum for a company of its size. This was a short-term fix, designed to protect sales momentum and maintain dealer confidence during a period of uncertainty. The move bought Mazda some precious time, but everyone knew it couldn't last forever. Absorbing such losses is unsustainable in the long run. Now, Mazda faces a critical crossroads. The company must urgently develop a permanent solution, whether that means shifting production, renegotiating supply chains, or finding new ways to cut costs. The dilemma is stark. Sacrifice profits to keep prices competitive, or risk losing hard-won market share in the fiercely contested US market. Mazda's predicament is not unique. It mirrors a broader crisis facing the entire automotive industry as global trade dynamics shift. Industry insiders, analysts, and rival automakers are all watching Mazda's high-stakes gamble unfold, seeing it as a test case for how to survive and adapt under the new trade regime. The outcome will likely influence how other companies respond to similar challenges in the months and years ahead. The cost of staying in the US market has skyrocketed for Mazda, but the alternative, pulling out of such a vital market, is almost unthinkable for the brand's future. In the end, Mazda's actions highlight both the desperation and the unwavering resolve of Japanese automakers as they navigate an era of uncertainty and upheaval. No Japanese automaker has announced plans to exit the US market. The idea remains a worst-case scenario. The ties are too deep and the stakes too high for a hasty retreat. Instead, every company is urgently re-evaluating its North American strategy, forced to adapt to a fundamentally changed environment. The 24% tariff is a structural shift, not a temporary setback. Boardrooms are now focused on survival, not just growth, weighing the costs of shifting production versus paying tariffs. The narrative is one of strategic repositioning, not retreat. The question is how to remain in the US sustainably, not whether to stay. The new era demands resilient, localized production and a fortified American presence. The clear strategy: if you can't beat the tariffs, build around them. Japanese automakers are accelerating plans to expand US production, reclassifying vehicles as domestic to avoid the 24% levy. Mazda, for example, is ramping up its Alabama plant, investing in new assembly lines and hiring American workers. This pivot requires billions in investment and a complete overhaul of supply chains. Even before the tariffs, Japan offered a $1 trillion investment package to the US, a sign of their willingness to double down on American soil. Ironically, protectionist policies are driving foreign companies to invest more in the US. The localization strategy is about survival, not just growth. Japanese automakers are digging in, building a deeper, more integrated American presence. The real cost of tariffs lands squarely on American consumers, who are already feeling the pinch of rising prices in many areas of daily life. With new car prices projected to rise by nearly $5,000 on average, families across the country are forced to reconsider major purchases, delay upgrades, or settle for less than what they need. For many, the dream of owning a new, reliable vehicle is slipping further out of reach, making it harder to commute, travel, or simply get by. The impact isn't limited to imported vehicles. US-built cars are deeply connected to the global supply chain, relying on thousands of parts sourced from around the world. Domestic automakers now face higher costs for essential components, from steel and aluminum to advanced electronics, which are often imported. These increased expenses are inevitably passed on to consumers, driving up the price of even the most American-made cars. Industry analysts warn that the total price hikes could reach as much as $10,000 per vehicle, depending on how much imported content is used in each model. This means that both entry-level and luxury vehicles are affected, squeezing budgets at every level and making it more difficult for Americans to afford safe, efficient transportation. Japanese automakers, who have established deep roots in the US, are major employers, supporting over 2 million American jobs and investing $61.6 billion in local facilities. Their presence has revitalized communities, provided stable employment, and contributed to the growth of the American auto industry. These companies are now facing uncertainty, as tariffs threaten their ability to operate efficiently and competitively. If car sales decline due to higher prices, the consequences could be severe. Layoffs may become widespread, and investment in new technologies or expanded facilities could dry up. This would undermine the very industry the tariffs are supposed to protect, putting both current jobs and future opportunities at risk. The pain doesn't stop at America's borders. Canada and Mexico, key partners in the North American auto supply chain, are also hit by new tariffs. This threatens the region's tightly integrated manufacturing system, where parts and vehicles cross borders multiple times before reaching the consumer. Disruptions here could lead to delays, shortages, and even higher costs for everyone involved. The disruption risks destabilizing a powerhouse industry that has long been a driver of economic growth, not just in the US, but across the continent. As production slows and dealerships struggle, the ripple effects could spread economic hardship far and wide, impacting suppliers, small businesses, and entire communities. Ultimately, it's the consumers and workers who bear the brunt of protectionist policies. As prices rise and jobs are threatened, the true cost of tariffs becomes clear. Not just at the dealership, but in the lives of millions of Americans who depend on the auto industry for mobility, security, and opportunity. Both Japanese and American officials have voiced deep concern over the tariffs' economic fallout. Japan highlights its investments and job creation in the US, arguing the alliance is mutually beneficial. American industry leaders warn the tariffs will hurt consumers and manufacturers alike, dampening demand and risking jobs. Even US automakers are bracing for negative consequences, stockpiling parts and rethinking logistics. Economic experts widely criticize the tariffs as a tax on Americans and a threat to competitiveness. The dialogue is tense, with Japan relying on negotiation and adaptation rather than retaliation. Both sides recognize the risk of unraveling decades of shared prosperity. Will Japanese automakers leave the US? The answer is a qualified no. The American market is too vital and integrated for a complete withdrawal, but business as usual is over. The new tariffs mark a turning point. The old model of export-driven supply chains is no longer viable. The inevitable response is accelerated localization, more cars and parts built in the US, more investment, and deeper integration. Ironically, policies meant to punish foreign automakers are making them more American. This transformation will be costly and complex, but it's the only logical path forward. The story isn't about Japan leaving, but about how its presence in America is fundamentally changing. Japanese automakers are adapting, reinforcing their foundations on US soil to weather an unpredictable future.